Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Today, we'll look at the Bitcoin price chart. We'll also talk a little bit about inflation and what I think it means for risk assets in the market. And we'll show you some on-chain data. I want to talk about some of the narratives I see going around on Twitter in regards to on-chain and how I think they may be a bit tone deaf in regards to what the market is actually showing us. So stick around for all that. If you enjoy this content, make sure to give my video a thumbs up and please subscribe to the channel. This is your home for Bitcoin and on-chain analysis, and I greatly appreciate all of the support you guys provide. But with all that said, we've got a few things to discuss. Let's get right into it. We'll start with the price chart today, as usual. Price is around 40,500 at time of recording, and it's looking for support at a really important juncture for price action. This marked the first peak of 2021, which was at the time the all-time high, and was the first real quality pullback of the 2020 and 2021 bull run. Now, this part of the market has been an area of intense study here on the channel. We've talked about how this was the zenith of market activity. This was the highest point of volume, of distribution, of spending by older coins, and generally marked the high point of all network activity. Active entities, active addresses, transaction counts, things of those nature, all maxed out in this range here. So seeing that we're now trying to turn that back into a support after many months of gathering is constructive, and I do like to see that. It's continuing our higher lows grind from the bottom here. And admittedly, it's very boring. It's hard to watch. It's challenging to come sit down each day and look at this price chart, seeing it not do very much and try to come up with some encouraging way to let you guys know that this is how markets play out. This is what a bull market turns into on the back end. It turns into months of price going sideways, testing various resistances and being rejected by them, sentiment flip-flopping wildly, and people wondering if it's ever going to end. All of that is happening now, and all of those things are very normal bear market behavior. And we are in a bear market, friends. We've been in a bear market certainly since this all-time high. And one could argue we've been in a true bear market in terms of activity and investor behavior since this moment back here. Kind of despite this big move, there was a lot of bearishness that remained on the network in the actual behavior and the nominal values of metrics we use to track this asset. In a lot of ways, it stayed bearish after this moment in the market here. So being on this side now in 2022, flip-flopping over key resistance, having pumps rejected without any real conviction stepping in, confidence seemingly fleeting and fragile. That's all very typical bear market behavior. And it can be difficult, right? It can be a patience tester. It can really challenge you to dig deep and examine your positioning and your conviction in your investments. These are the times in the market when people tend to just bail out and give up and walk away. But we're seeing this constructive price action. It's very slow, it's very grindy, but we're positively growing out of this range. And in fact, this is a pretty clean parallel channel structure. And what we've seen since this parallel channel really got established, first we kind of wick below it, and then we move back to the channel highs. We get rejected, we come down, we wick below it, and then we move back to the channel highs. That's happened a couple of times. And in fact, this fractal right here is playing out almost identically again. Here, I'll take it off my screen and redraw it just so that you can get a sense of what the heck I'm talking about. So we are essentially playing this pattern out again. Will it follow it exactly? It's hard to know. Bitcoin is a pretty mechanical asset. It likes to repeat itself. If I'm just gonna look at what price has been doing recently, well, each time we've broken below this channel before we moved back to the channel highs, we've gotten about a 6 or 7% wick. It's been about 6% and change. Now, we didn't get a deep one here, this most recent test of the channel lows, but we got it in each of these instances. So let's just play a little game of what if. What if we get a 6% wick here at the bottom of the channel before we move back up? Where would that put us? Well, according to my little model here, it would put us right in the middle 37s, around 37.5, 37.300. Now, there is one issue with that. If we actually wicked down to this level, it would invalidate this as a higher low. So what we would really need to see it do is stop above that level, maybe at 38,000. So I'm wondering, can we identify any oscillating indicators or any trend lines that would give us support around 38,000. And I believe I have one. Throw on a couple of my indicators here. So this line that I've got down here at the bottom is part of an indicator set that is a rolling retrace, a rolling 50% midline between different price ranges. And this one in particular is the 720 day, which is essentially a 2-year rolling median of price. And that level, friends, right now is 38,200. Now, if we were to wick down here, like we have seen wicks before, that would hit a key support level and it would retain a higher low structural integrity for this channel. So right now, if I'm going to give myself some kind of specificity to look for, something to watch as we're sitting here in this really boring range and not really sure what's going to happen, then I would probably look for a bounce down to around 38,000. 38,200 is the actual value of my indicator, which you can see has been holding up pretty well. It's provided some integrity. We bounced below it earlier in this kind of dip before we established the channel, but you could almost consider that kind of a deviation move. But it has held support here throughout the February and March consolidation, so I would hope that it would hold support again. And we'll see, right? As we trudge through this bear market, we'll see if price action behaves the way we'd like. That would be a friendly outcome, seeing it bounce off of this. If we were to get below this level, we would be setting lower lows that would create a structural invalidation. It would be a market structure break, and then we would have to reassess all over again. That's my base case. Could be wrong, but based on what we're seeing here, that seems reasonable to me. And there's a bit more I want to talk about in regards to Bitcoin. So I've been seeing a lot of charts going around on Twitter, people showing things like dormancy flow, which I will touch on here in a moment, and trying to establish that we are in a quote unquote value zone for Bitcoin. Now, I can't argue that. When we're at the bottom of a macro range, that is a value zone, right? Price is lower than it has been for the majority of the year. So the fact that we're down kind of below this median of the macro range, I would say anything down here is a value zone. But what I think is getting lost in some of the translation by various analysts who are peddling these charts on Twitter, I think that they are failing to educate their viewers on the truth that we are in a bear market. And when I look out across the on-chain landscape, it looks like a bear market. There's very low activity. The majority of the measurables that we can see on the ledger itself pertain to coins maturing, getting older, sitting still, and gaining coin days every day that they are idle. And there's a lot of buzz going around on Twitter about Bitcoin being in a value zone. And I see this chart in particular shared quite a bit. This is called entity-adjusted dormancy flow. This metric is the brainchild of my buddy David Puel, who's one of the OG on-chain analysts. He's contributed a ton to this space. And what this metric is showing, it's a ratio between the market cap and the US dollar value of the last year of spending on chain. When this value is elevated, it tends to align with bull markets. It means that the market cap valuation and the spender motivation are in alignment. That tends to happen throughout a bull. As you can see up here, it sustains a high value. Market cap is high, spending on chain is high in terms of volume and age, and those things are in alignment with each other. Now, when this metric declines and it's showing low values, it's really a bottom catcher more than a top caller. This metric at bottoms is indicating that the current volume of spending on the ledger itself on chain is at a yearly low relative to the market cap. That tends to occur in the depths of bear markets after a period of high spending. This metric is intensely reliant on us having a period of high volumetric spending in the past year to elevate the metric, to compare itself against. And when we see low values, it's just showing you that there is not a lot of volume, and compared to the past year, we're at a low point of spending. That's generally what it's showing you. Now you can see it's only hit bottoms 5 or 6 times in Bitcoin's history. Some of them have been very brief visits, but what we've seen in the last, month or two, we've spent a lot of time down here. I guess it's more than 2 months. It's been about 3.5 months that we've been chopping around at the low end of dormancy flow. Now, I see a lot of my colleagues on Twitter sharing this chart. Oh, this is extremely bullish. The bull market's back on. Look where we are with dormancy flow. And as you guys know who follow me, I'm a pragmatist. I'm not here for romantic narratives. I'm here to study these metrics, to better understand them and to convey that information to you. And this metric being down here doesn't mean that we're now beginning the bull market. All it's really saying is that we are a full year removed from a period of very high spending, and that what we're seeing now is nothing compared to that. It doesn't mean that the bull market is back on, but it does mean that we're in a period of intense bearishness. And the ironic thing is, everyone who has presented this chart on Twitter in the last few months has presented it as if it means we're at the beginning of the bull market. Well, I think that's a bit silly, because when you look at this chart, every time that we're at the lows means we're in the middle of a bear market. Look at it, guys. That's what this metric is telling you. Now, it does mean that if you believe in the long-term success of Bitcoin, if you have a low time preference, if you have an investment thesis in Bitcoin and you have no intention of trying to realize profits in the next 6 months, as I don't, right? For me, it is a long-term investment. It's a savings vehicle. If you were to look at it from that perspective, you could make the argument that we are at peak value. As long as you are down in this green zone, that's a great signal to be accumulating Bitcoin for the long term. That's how I would interpret this, and that's what I think is the most accurate way to describe the signal this metric gives. But what it does not tell us, and what I want you to understand as my viewers when you see things like dormancy flow being shared around, it doesn't have anything to do with us being in a bull market. And I want to clarify that. We're in a bear market. That's why we're here. And I think that it's incumbent upon analysts to be open about those things. It's not scary to be in a bear market. It's scary to be in a bear and still think we're in a bull market. That's what's scary. That's when people get over their skis, when they bail out of positions because they don't understand the climate of the market that we're in. So I went on a long rant there because I just want to clarify, to crystallize this perspective that when we see metrics, particularly on-chain metrics that are derivatives of spending volume, as this one is, as many of them are, and they're presented as a value zone. Oh, look how low this metric is. That probably means we're in a bear market and you should act accordingly. For me, that means stacking heavily for the long term. That's my plan. It isn't investment advice for you. I'm not qualified to give anyone financial advice, but I perceive these kinds of metrics as triggers for ultimate value. Now, since the last time we spoke, we found out about the latest inflation print. We got the CPI report on Tuesday, and it came out at 8.5% year-over-year inflation. Now, that's all CPI. Core CPI, I think, is down around 6.5%. Core CPI removes food and energy, which are the most volatile of the items in the basket. But I think it's a bit silly to remove core CPI. The volatility is part and parcel of our living costs, and there is nothing else in the world that exists without food and energy first being paid for. So I don't dismiss, but I discount, in a sense, the core CPI value, which is this lower one. And I think the headline CPI and the rate of change month over month are more important. And look, month over month, it's rising significantly, and year over year, it's the highest it's been in a long time. Here is a chart I made of inflation. So up at the top, this black line is year-over-year consumer inflation. All items. I did not remove food and energy. And it's going back to 1966. And if you see inflation, the black line, again, through the majority of my lifetime, okay, I was born in the early 80s. I was born around here. Inflation has managed to stay around 3 to 4% for years, and even lower than that. But you can see back here, basically since 2020, consumer price inflation has been skyrocketing. And this value in the background that it's being compared to is the yield on the US 10-year Treasury. Now, the 10-year Treasury is kind of like the flagship for longer-term interest rates. It's the instrument that many economic indicators use as an index for future yields and for the cost of the dollar into the future. And we can see that inflation for many years was below the yield of the 10-year Treasury, which meant that generally speaking, bonds were a safe place to be. You could put your money in a 10-year note and you could trust that its buying power would be preserved into the future. Well, that dynamic has been deteriorating in recent years, and you can now see there is a major disparity between consumer inflation and the yield on the 10-year Treasury, on the money that you would make for committing dollars to the US government for a decade. This value in the center of the screen, this blue, is the difference between these two lines declines. Look, for the majority of my lifetime, it was negative. This value was below the median, which is showing that inflation was considerably lower than the yield on the 10-year treasury. This is what you could expect to make in real terms when all is said and done when your bond reaches maturity. This value has been collapsing towards zero and now has skyrocketed to a 6% premium, which means that people who buy a 10-year treasury note today, which is supposed to be one of the safest assets that anyone can invest in any market globally, that is currently giving you a negative 6% real yield based on inflation today. Now, obviously, inflation today will not match inflation 10 years from now, but it still gives you visually an understanding of how much disparity there is between the quality of the money and the inflation rate. And currently, they're going in opposite directions. Yields on treasuries falling, inflation rising. And it's a big problem to have inflation be this high because of the levels of debt. Now, this chart at the bottom that I haven't mentioned yet is debt to GDP. It's total public debt to gross domestic product. This value was under 65 until the great financial crisis. It stayed at 65% or lower all the way back to mid-century. After the great financial crisis, QE began and federal debt ballooned to 100% of GDP, and it hovered around that value throughout the 2010s. It was in 2020 when the Federal Reserve stepped in with historic stimulus, buying up corporate junk debt, injecting money into the system, backstopping the treasury market, all of the measures that they took. Federal debt to GDP ballooned to 135%. Now, those of you who follow my channel regularly, you recall a video from a couple of weeks ago called The Inflation Playbook. I'll leave a link in the description below for you to go check that out. And I talk about the tools available to a sovereign to deal with high debt levels during a period of high inflation, which is what we currently are experiencing. And it's vital background information for you to understand where we are in the market right now. So the Federal Reserve is currently sitting on 123% debt to GDP. They've been able to whittle down about 10 or 12% in the past year simply by allowing inflation to run hot. When you have a scenario where federal debt to GDP is well over 100%, while we have generationally high inflation causing negative yields for anyone saving in US dollars. When we have that scenario, while the Federal Reserve is talking about tightening, it's planning to raise interest rates. It already has begun to raise interest rates, and it will continue raising interest rates until it is told not to by the markets. When you've got those things happening, tightening occurring at a period of record debt and record inflation, that climate is not one that bodes well for risk assets. I'm not just talking about ARK Invest and Shopify and Teladoc and things like that. I'm talking about Bitcoin and Ethereum and all other crypto assets. When you have a global economy that is tightening, liquidity is being pulled. They're already planning on floating quantitative tightening in the next couple of months. They will continue to raise interest rates, but not enough to catch up to the inflation rate. The climate that we have to look forward to over the next few months for the market is one that does not bode well for things like Bitcoin. It feeds into my expectation that we are not on the way to new all-time highs. Now, it doesn't mean we have to go down from here, but it does mean that this sort of choppy price action, trapped within a range inside of a larger range, is the most realistic outcome of the bevy of possibilities that we have before us. So the point I'm trying to make today, friends, is that I am feeling apprehensive about the markets. I don't believe that Bitcoin will make an all-time high this year with the current market climate. Things would need to start changing. We would need to see a loosening up of economic conditions rather than a tightening of economic conditions. And I think that a lot of people in this space, a lot of analysts, a lot of forecasters, a lot of influencers who post cool charts are modeling for an economic climate and a market climate than we have not had before. They're expecting that the same things that have played out for the last 13 years will play out for the next year or two. I'm not on here to tell you that this time is different. In fact, I'm on here to tell you the opposite, that this time is like all other times before. We are nearing the end of a secular bull market in all global assets. We are seeing a tightening of financial conditions. An historic sell-off in the bond market has has led that movement. And the Federal Reserve is committed to a schedule of raising interest rates, which they will continue to do until they break something, because that's what they have done historically, and there's very little reason to suspect otherwise. So these ingredients of this market are not favorable to Bitcoin. They're not favorable to assets far out on the risk curve. Is it possible that we still see a relief rally in the face of all this bearishness? Absolutely. The market can climb a wall of worry, especially when you have so many investors allocated to defense, allocated to protecting themselves against their fears. That can provide a lot of fuel. If a rally does begin, if a bid is found, those people can become FOMO-induced buyers. But that's a long shot, and that's not my best case probability as of now. I think what we're in for is climbing back into this range, and then probably a couple more months of this kind of price action. Getting back up to 52K and breaking over this level will be a monumental task, and one that is not likely to happen quickly, not in these conditions. And it's important to me, since I have this channel and I now have an audience of over 12,000 people, it's extremely important to me that I come on here and I be honest with you. When there are bullish things to talk about, we'll talk about them. When there are bearish things to talk about, we will discuss them. And right now, the market is telling us that tightening is the recipe, tightening is the plan, and the Federal Reserve is not going to pivot just because of a 10% fall in the NASDAQ. They will continue to raise interest rates. They will continue to tighten. And that is not an environment where Bitcoin and crypto can expect to do well. So that's my current base case. I don't know if we'll start to see a loosening of financial conditions over the next couple of months. Something would have to shake out. Maybe an easing of the conflict in Ukraine. That could be a very dovish catalyst and one that helps provide a boost to the market. But barring something like that, everything we talked about, I believe, is going to play out to the detriment of risk assets. Be sure to follow me here on Twitter at TXMC Trades. It's a great place to ask me questions and interact, and I put a lot of my charts on there that don't make it in the videos. And that's where we'll leave it today, friends. I expect that some of my comments may be unhappy for expressing so much bearishness, for not having some hopium to dispense to you on this beautiful Good Friday afternoon. But friends, if you're on this journey with me, it's important that you understand where I come from. And I come from a place of incessant pragmatism. I'm not going to come on here and shill hopium to you just because it's what feels good. I have to come on here and tell you what I see, give you an idea of what I think is going to happen, and lay out a base case. I do that with a data-driven approach, and I try to leave my emotions at the door. Could I be wrong? Yes. I would love to be wrong, and I would be one of the happiest people about that, because it would mean number was going up. So we'll wait and see. If you have any questions for me, if you have comments about what we talked about, or feedback for me regarding this channel, be sure to leave them down below, and I will happily read through them. I read all of my comments. And we'll look to make another video maybe on Monday or Tuesday. We'll let the Easter weekend play out. It's probably going to be a quiet one. And we'll see what Monday has in store for us. So until then, take care of yourselves, friends. Find time to enjoy your weekend. Be kind to each other. And we will chat again very soon. Cheers, everyone.